Hey, everybody. Welcome back to The Long Game. I'm Brent Schafer. Along with me is Tyler Pearson. We are both certified financial planners sharing topics of conversation that we're having with our clients. Tyler, how's everything going?
Going great, man. How have you been?
I'm good. I'm good. It's November. It's
Yeah,
3:30 and
it's dark
um
out.
it's dark out. It's getting dark. So why don't we just jump right into this? We'll make it quick, we'll make it brief, make it fun, make it interesting, then we'll get out of here. Okay, Tyler. So today I want to talk about the top US stocks. Right now, with the market that we're in, they're kind of getting a lot of headlines, right? AI, all
Yeah.
of these things that are going to change the world. So let's jump in the Wayback Machine and kind of go look at where we've come from. So obviously, this is a chart of the top 10 stocks every 5 years, 2025, going back to 1980. What stands out to you? What do you see?
Yeah, I mean, number one, like Brent said, it's top US stocks by market cap. And the number one thing I like to point out to clients when we're looking at this is obviously there's a lot of different companies on this chart. It's hard to know, where the top 10 companies today are going to be in 10 years. But even beyond that, I like to point out that, hey, the industries change as well. What industry or what stocks from what specific industries tend to be at the top in any given year changes as well, especially as you look at it over a 10, 15-year time horizon. I know you've told or pointed it out before, Brent, that in the 80s, you're looking at a lot of energy companies, Shell, Chevron, Exxon. You're not seeing those companies in 2025. It's all tech, right? It's kind of on the back of AI is going to change the world. And so I always like to point out that it's not just the fact that companies don't necessarily maintain their appearance in the top 10 for a long period of time. It's also industries.
Yeah, definitely. We talked about it kind of briefly before we jumped on here. These top 10 companies, they might seem bulletproof, but you never know what can happen. I think the other thing, Tyler, that, let's say that somebody buys an S&P 500 index fund. We talk about buying and holding a basket of stocks. Well, when you invest or purchase these mutual funds, ETFs that replicate an index, they're reconstituted every so often because companies, they reach that top 10 or S&P 500 and then they eventually or potentially fall out of it too. You could be potentially just buying one name
Mhm.
as an index fund, but really in that index fund there are many different companies that you're also potentially buying. So let's change the chart here. And I think that when we were chatting about this beforehand, the one word that you used to describe it was interesting. And Tyler, why do you find this interesting?
Well, and charts are obviously designed in a specific way to make them interesting. But I don't think this one took a whole lot of work. I mean, if you look at 85, 95, 05, and 15, and we look at, what percentage of the S&P 500 that the 10 largest companies make up, it's not perfect, but it's a pretty consistent trend hovering between 18 and 20, 22%. And then we're looking at 2025, and it's this, drastic outlier up near 40%. And so that's really for me, it's kind of a mind-boggling puzzle. Why is that? I know literally why it is, but why are investors all paying prices to get these stocks and building up the market cap the way that they have? And I know you have a lot of stuff you want to touch on as well, but that's what jumps out at me, and it's the reason I find it interesting.
I definitely would agree with you. I think the few other points that I want to touch on is, again, hate to just keep going back to it, but index funds, diversification, right? Like they're not quite synonymous, but they're really close. And to think, man, I am purchasing 500 companies with one name, right? SPY, VU, whatever. And 40% of my money is going to be in 10 names. And those 10 names are in the same sector, same industry, technology. I mean, granted, JP Morgan and Berkshire Hathaway, they're kind of on the fringe there, but 7, 8 of the top 10 companies pretty much do the same thing or are in technology. And that just doesn't sit well with a lot of people because it's counter to what we've become comfortable with
Right.
historically.
Yeah, and I think, one of the things that always jumps out to me when we talk about diversifying, and in this case, where you're kind of referencing diversifying away from the heavyweight that you see in some of these big tech companies. It's not to say that Apple or Nvidia or Microsoft or Amazon are, bad companies or are going to be bad stocks to own. It's just a matter of, hey, you got to know what you're buying. You're buying the S&P 500. I know people that think they're buying an equal share in the 500 biggest companies, and that's absolutely not the case. And so it's just an educational piece. And then obviously on top of that, I find it interesting just how heavy that concentration is in those top 10 companies.
I think that's well put, Tyler. I don't want to try to add any more. That was a very good thought there. Let's talk about PE ratios. Why not? We're right here.
Might
Something that's also
seems like
interesting.
it's a good segue.
Yeah, because you mentioned it the past when we were talking about the other slide on how have these companies gotten so big, and they're trading at valuations that are very high and that require very good performance, amazing performance. And so this is another one that I like to go over with clients. It's just showing the forward-looking PE ratio of the S&P 500 over the last 30 years. And I also like to walk through and kind of tie them to specific certain events. So we've got the dot-com bubble, right? And you can see that's kind of the last time that we were in this territory for price to earnings ratio of the S&P 500. We've got very, very bottom of the financial crisis when we get down to 10x. COVID, you can see COVID in here, kind of that flash in the pan, and then we were back. Then there was when the Fed decided to raise interest rates and try to fight inflation, really kind of threw the brakes on everything. So we see a contraction there. And then ever since that, we've kind of just been growing back. The 30-year average is 17 PE. So the price is 17 times more than the earnings that you're purchasing. And another thing we were talking about before we hopped on was the price that you pay is a good predictor of your future expected return. Now, it's not to say that things can't keep going up, but typically when you pay for something that's higher than average, as an investor, you're expecting to take a little bit less or have a little bit less forward-looking return because you've had to pay a higher price to acquire this asset. So, Tyler, anything I missed? Anything you want to add?
No, just to add on at the very end there, you can expect a little bit lower returns or you're expecting earnings growth. And I think that's kind of what a lot of investors are looking at with companies like NVIDIA. They think earnings are going to grow by an astronomical number because of the product and services that they're offering. But otherwise, I think you summed it up. It's always fascinating to take metrics and put it back to the stories of the late 90s into the early 2000s and the Great Recession. And then recently, it seems like it just happens year after year. It's like COVID and then 2022, and then we've kind of climbed our way back up. So
it's been pretty volatile these past couple of years. And
certainly,
yeah, the fundamentals have stayed the same, right? Price that you pay, the earnings that you get as a company, the makeup, the products that have been sold are a little different, but just going back to the fundamentals, man, seems like we can never escape it.
Nope.
All right, Tyler, I think 3 is enough for the folks at home. Oh, and then I had some homework I wanted to give people. So like you were talking about the S&P 500, and when you purchase one of those funds, it's not that you get 1/500th of each fund. It's the typical way of doing it is there's a market cap weighting, and that portion is allocated towards each company. So if NVIDIA's 10% of the market, then 10% of your money's going there. But for the folks at home, if they're curious, if they're interested, just look up the S&P 500 and to see, kind of read through, go through the company names. Obviously, you're going to notice some, but I always found that, again, interesting just to see what names are out there and who is in that 500 and what companies sit at the bottom, the 400 to 499, 500. Those people are happy, like, hey, we're in the S&P 500, let's go. But anyway. All right, Tyler. Well, thank you for joining me today. We will call it there. And folks at home, if you got questions about investing, reach out to Tyler, reach out to myself. We'd be happy to chat with you, go through your current investment portfolio, maybe see if there's anything that you want to change, especially while valuations are high, right? Maybe take a little advantage of where prices are at today. So anyhow, thank you for watching The Long Game, and we'll catch you next time.